Dividends can be a great investment tool to build wealth over time passively, and if you follow everything in this video, you're going to learn some of the best ways on how you can build an income stream to potentially live off of one day. But if you don't know everything about them, you could be in some serious trouble, so let's get straight to it by first going over why you would even want dividends. Now, dividends are basically a portion of a company's profits that they are paying to the shareholders as a reward for owning their stock. For example, a company might have a stock price of $100 per share with a dividend yield of 5%. The 5% is going to be the amount you would earn throughout an entire year of owning the stock. So if you had one share at $100, that means that you would get $5 after a full year. It's not that much, but if you had 100 shares, that means that you would have $10,000 invested, and that would generate you $500 per year in dividends. Now, most companies pay dividends out quarterly, but you could find other options such as monthly dividends as well. So if it were quarterly from the previous example, that means that you would get $125 every 3 months, or just over $40 every month. And companies offer dividends because they are trying to attract new investors to buy in their stock by showing that they have a strong financial position to regularly pay an income to their shareholders. But you do have to be careful because some of the companies pay extremely high dividend yields, such as the double digits like the ones right here, but they're typically companies in poor financial positions and ones you should probably avoid. My motto with dividends is that if you are going to use them, you need to look for consistent growth along with the investment. To better understand why I say this, if you were to get an ETF like the Super Dividend ETF SDIV, they currently have a dividend yield of 9.6%, which sounds amazing, but the annual returns, even if you reinvested the dividends over the past 10 years, would have actually generated you a negative 3.89%. That's literally what the dividends being reinvested into the fund. If you were to take the dividends as income, your portfolio would have lost money at an average annual rate of negative 11.48%, which means if you had a $100,000 portfolio with this ETF, after 10 years, you would now be just under $30,000 and your dividend income would be significantly lower, being a negative impact all around. Whereas with a popular ETF such as the Schwab US Dividend Equity ETF, ticker SCHD, this one historically has done extremely well. It tracks the US Dividend 100 Index. It has a dividend yield of 3.46% and would have grown at an average annual rate of 10.91%. Now that's assuming that you reinvested the dividends back into the fund. If you were to take them as income instead, your portfolio wouldn't have grown as much, but you still would have seen a solid growth rate at an annual return of 7.58%. That means that a $100,000 portfolio over 10 years would have turned into $208,000 in value, and throughout that time, your dividends would have grown from $3,000 in 2015 to now getting $7,000 in the year of 2023. That right there is the power of compound interest, which basically means when you invest and make money, it is going to compound the growth on that money so that over time, you're just going to continue making more and more money. Now, a very important topic to understand is the difference between qualified and non-qualified dividends. Qualified dividends means that the dividends you earn can be taxed at the long-term capital gains rate, which is much lower than the ordinary income tax rate. And let's say you're single and your taxable income is under $47,000. If $5,000 of that was from qualified dividends, you'd be taxed at 0% on the $5,000. The same concept applies if you're married filing jointly or head of household, and you can see if you made $150,000 in income, that would be taxed at 15%. For example, if it were qualified, the $10,000 would be taxed at 15%, so that's $1,500. Just be aware if you're an individual who earns more than $200,000 or more, or if you're a married couple getting $250,000 or more, you're going to have to pay an additional 3.8% on investment income, including qualified dividends. So from the previous example of using SCHD and getting $7,000 in the year of 2023, that could actually have been taxed at 0%. So to be a qualified dividend, the dividends must be paid by a US corporation or a foreign company where you must hold the stock for at least 60 days starting before the ex-dividend date. All in all, just hold the investment long enough and your wallet will thank you later. Which, just so you know, ones that may not qualify for the dividends are real estate investment trust companies, certain bonds, or any investments using hedging strategies to provide the income, which I'll cover more on later in the video, but the dividends here would be taxed as ordinary income. Now, I highly recommend you do your own research before making any decisions with your dividend investments because you could actually be taxed much more than you would have thought. Because of that, starting a high growth portfolio in a retirement account like a Roth IRA to eventually get dividend income that is tax-free through investment options that are not tax efficient, such as REITs, bonds, or balanced funds, that would be ideal. And that's because once you meet the requirements, at any age after 59.5, you could take dividend income from any investment options you choose, no matter the tax structure, and the dividend income will be completely tax-free, as well as the growth of the entire portfolio. I'll go over a real-world example of this later in the video and how exactly it can be done for you. So by understanding dividend investments, your portfolio could grow in value as well as the dividend income, which would help hedge against inflation. And by having dividend stocks, they are typically well-established companies with stable earnings, so in poor economic conditions, they are still considered safer options, especially if you get ETFs that improve the diversification. So now that you understand why dividends can provide tremendous value over time, let's now go over the process of opening up an account. The first questions you're going to want to ask yourself is what kind of platform are you going to pick and what type of account are you going to want? If you plan to get dividend income that are not going to be from qualified dividends where you can get long-term capital gains, if you can't do that, then I would look at other options such as a Roth IRA. Although you wouldn't be able to get the dividends as soon as you want, your future self will thank you 100 times over. But for most of you seeking dividends right now, a typical brokerage firm is what you're going to need, and you could use platforms like Webull, M1 Finance, SoFi, or Fidelity. There's many options and they're all pretty much similar, but I will let you know that on Webull, you can get at least $30 worth of free stocks when you make your first deposit of any amount. Then M1 Finance, a $75 bonus or more if you start with $10,000 or more. And then SoFi, you can get $25 of free stock if you deposit over $10, as long as you haven't gotten a bonus with them already. And then for Fidelity, that's where I have my Roth IRA, which is where I've had mine since I was 18. Like I said, there's many options, but these are the ones that I've used and recommend, and I'll have the links to sign up for all of them in the description of this video. But to sign up, it's as simple as filling out your personal information, linking a bank account to the platform, and depositing money, where once the funds settle, you can move on to choosing your investments. In regards to investments, you could buy individual stocks, where some of them would include Home Depot, JP Morgan, Procter & Gamble, and many others that if you do the research and believe they will sustain business long term, could do well for you. If you plan to get individual dividend stocks, there are a few simple things to look at, with one of them being the past 10-year performance. Now, although the past doesn't guarantee the future, it does provide an additional assurance before going into a specific investment. Besides that, you'll also want to see the dividend yield to see how much the company is truly paying to its shareholders for owning the stock. If it's ridiculously high, I would be cautious to proceed. Furthering that with individual dividend stocks, make sure to check the consistency with their dividend payouts. Companies that are inconsistent with this are inconsistent with their capital, which is a negative image for the company. An option I like to refer to with this is General Mills stock, because they have gone 124 years with consecutive dividend payments. And with singular stocks, you could also look at a company's earnings per share, PE ratio, debt to equity ratio, and free cash flow to determine sustainability for a company. But with dividend ETFs, you can avoid spending a ton of time in these areas, and you're more likely to generate even greater results. So with dividend ETFs, they are basically a way to get many different types of dividend stocks all within one purchase. Having 100 companies that average a dividend yield of 3% compared to just a couple stocks would reduce significant risk and is also much more convenient. And plus with these, if one company misses a dividend payment, you're not going to see much of an impact. So with dividend ETFs, something you may want to take a look at is the expense ratio, which is the total cost it takes to own the fund per year. Now, there are some ETFs that have a 0% expense ratio, but for the most part, they're going to have some sort of cost to them because they're automatically created and managed for you. All you have to do is click two buttons and they'll track an index, or someone will actually be managing the fund for you. So speaking of this, one of the best dividend ETFs is the Schwab US Dividend Equity ETF, ticker SCHD, that tracks the Dow Jones US Dividend 100 Index that comes in an expense ratio of 0.06%, which means every $10,000 you invest in this fund is going to cost you $6 a year in fees, which is less than a box of pizza. So on the other end of things, if we look at an actively managed ETF, let's look at the JP Morgan Equity Premium Income ETF, JEPI, that is an actively managed ETF that pays dividends monthly and seeks to generate income through stock dividends and option premiums. This fund comes in an expense ratio of 0.35% with a dividend yield of 7.51%, and over the past 4 years since it was created, it has averaged a 12.24% annual return. Also, just a note for you, the annual returns that you're going to see include the expense ratio and dividends reinvested back into the fund. I'll be making an entire video about dividend investing in the near future, so keep an eye on that. I'll have the link in the description below once it's created, and don't forget to subscribe. And because you've stayed this long into the video, here are a few of my top choices in regards to dividend stocks. The first one being Home Depot HD, General Mills GIS, then JP Morgan, Johnson & Johnson, Procter & Gamble, Realty Income, Starbucks, and a few of Warren Buffett's top ones consist of Bank of America, Citigroup, Chevron, Apple, and Coca-Cola. In regards to traditional traditional dividend ETFs, SCHD is my favorite. Then you could also consider the Vanguard Dividend Appreciation ETF, VIG, or the iShares Dividend Growth ETF, ticker DGRO, are also solid options. And for monthly dividend ETFs, I would say JPQ, JPI, DEVO, and DGRW, where my last video showed a combination of all these in a portfolio that generated a 17.6% return over the year of 2023. If you want to see that video, I'll have it linked in the description below. All in all, just understand the tax structure for some of these monthly incomes, because JPQ and JPI are considered ordinary income through their option strategies. So a Roth IRA would be ideal for this case, which I'll cover on shortly. Now, for all the investments I just showed, if you take the dividend as income with a $1,000 portfolio, you're not going to be getting much in dividends, but as you contribute more and continue to invest over time, getting to a point to potentially live off of dividends is possible, but it takes time and is actual work. In fact, CNBC states that the national median for living comfortably alone is roughly $90,000, and I'll show you ways on how you could actually achieve this as I go over building a portfolio. So the first question you need to understand once you pick the investments or have a rough idea is, what type of portfolio are you going to use? If it's a taxable account, aim for the qualified dividends so that you can get the long-term capital gains rate. Now, obviously you must do your own research and make your own financial decisions, but here are a few general ideas to think about. The first is, if you want individual stocks, I wouldn't recommend only doing this, but instead something like 25% in singular stocks that you research and trust long-term, and then 75% in strong dividend ETFs. If you're going to pick individual stocks, unless you're Warren Buffett or Ray Dalio, I definitely recommend to limit the exposure to one company to 5%. Obviously, that's a personal decision, but here are the top 25 dividend stocks from Warren Buffett's portfolio that you may be interested in. As you can see, there's Kraft at a 4.4% yield, Chevron at 4%, Sirius X, and many others. If you stop the video, you can see, like Coca-Cola, Ally Financial, Bank of America, Capital One, Paramount, Visa, Costco, MasterCard, and of course, his huge stake in Apple. Buffett's company, Berkshire Hathaway, literally has 900 million shares of Apple, which is $174 billion, covering 50% of his portfolio, which is 6% total ownership of Apple's company. Ironically enough, though, he recommends someone to invest 90% in the S&P 500 over his own Berkshire Hathaway. All right, so besides getting individual stocks, a simple way that you could go about this is just getting all dividend ETFs. Like SCHD, that has 103 different companies, with the top ones being Texas Instruments, Pepsi, and Chevron, to name a few. The dividends with this can also become qualified, which means if you hold them long enough, you can get much better tax rates, as well as the long-term growth of the actual investment. All in all, SCHD has historically proven to be one of the best dividend ETFs that you could own, especially for taxable accounts, which there's so many different options you could look into. If you have any suggested ones, drop them in the comment section below for others and myself to check out. So in regards to using ETFs in a portfolio, a simple tool I'd recommend using is a fund overlap tool, where you can see how similar the investments are within each fund. For example, VIG and SCHD have a 12% overlap by weight, which means the investments inside of each fund are not very similar. Where an S&P 500 fund like VOO versus the total stock market fund VTI have an 86% overlap by weight, which is because the large cap companies in the S&P 500 are also in the total stock market fund. Just so you know, I'll leave a link to the overlap tool in the description below for you. In regards to building a portfolio, an important thing to understand is the simpler, the better. Avoid investing into too many options, because it's just going to overcomplicate your portfolio, make it harder to manage, and a few simple ETFs can take you a long way. Personal experience, since I've been long-term index fund investing, my portfolios have grown significantly more than when I tried to invest in individual stocks. So hold long-term, keep adding to your investments over time, focus on other things in life, and don't forget to subscribe to this channel. So last but not least, using a retirement account like a Roth IRA, where you can get tax-free income and growth on the entire account. Now with the Roth IRA, there is a limit on how much you can contribute into the account, and for the year 2024, that amount was $7,000 per year. Just know the get rich in 1 month is not how this works. To keep things super simple, let's say that you're 30 and you bought the highest growth ETFs you believe can get you an average annual return of 10%. In the years of building up your Roth IRA, you want to prioritize going for that high growth, because you're not going to be touching these investments for a long time. So let's say you contribute the $7,000 per year, which is equivalent to $583 per month or $19 a day in this retirement account, and you do this until the time you are 60. You may say that's hard to do, but of course you have to be disciplined to the plan, and to me, an extra $19 a day is possible for anyone that puts their mind to it. For those that are stuck on this, look for more ways to make just a bit more, like starting a side hustle or consider tightening your spending. But by reinvesting the dividends or simply having high growth investments, that means by 60, you would have built roughly a $1.3 million portfolio. If you then wanted a high monthly dividend income, you could then consider other options like JPQ, JPI, and Devo. Each of these ETFs have averaged a 10%, 7.3%, and 4.5% yield that pay you a monthly income. And so far, all the ETFs have seen solid annual returns, so if you were to take the dividends as income, you'll still see some growth, but just not as much as 10%. But theoretically, if you were to purchase these, you would average just over a 7% dividend yield. Sounds crazy, but these investments are meant for income because of their hedging strategies, why they're considered ordinary income, but in a Roth IRA, it doesn't matter. So you could have complete control over this, and with the general guideline I just showed, by age 60, you could generate $93 per year, which is close to $8,000 per month in completely tax-free income. And yes, you do have to consider inflation, but I still think that could do you pretty well in 30 years. Now, to be clear, you should not rely strictly on this type of approach, but you would still have $1.3 million in that account that you can withdraw at any time after that completely tax-free. But if you actually could live off of that income alone, that means that your portfolio would still grow enough to keep up with inflation. Alright, so I know many of you aren't younger than 18, but I just want to emphasize the importance of starting this Roth IRA as soon as possible, because if you did at 18, you would now have a $4.1 million portfolio. That means you would be able to generate $300,000 per year using the dividend strategy I mentioned, which would be $25,000 a month in tax-free dividend income, along with a $4 million portfolio that's completely tax-free. If you do not care about a Roth IRA, I hope this is something that changed your thoughts, because once I learned all of this, since I was 18, I've made sure to hit the max contribution every year. And for those with a high income that are curious on how they can also benefit from this, you can do what's called a backdoor Roth IRA, which I'll make a video on in the future. To conclude, just remember it's not all about a high dividend yield, but more so the total return of the entire investment. Besides the growth, make sure that any dividend stocks you invest into have consistent payouts and are strong, well-established companies. And depending on where you're investing and what exactly you are looking for, look into the tax treatment for that specific dividend investment before you make any decision. I discussed recently on a video how waiting to invest is a huge mistake to avoid, so get started today. Even with $10, if it's not $1,000, you're going in the right direction for your future. If you want to start a portfolio with Webull, you can get at least $30 worth of free stocks when you make your first deposit of any amount, or you could also consider M1 Finance, SoFi, or Fidelity, which I use all four of them for different types of investments. With that said, I'll leave all the links to my free resources and platforms for you to sign up on in the description below. And as always, don't forget to hit the like, subscribe, and notifications button for future content like this.